Welcome everyone today. Welcome to our Gorilla Doctors program. Thank you for joining us. We're calling this program How to Maximize the Impact of Your Charitable Giving. And our focus will be doing exactly that. So my name is Gary Kilbourn. I'm honored to serve on the board of directors for Gorilla Doctors. By day, I work as a portfolio manager and wealth advisor at the global wealth management firm of UBS based in Switzerland. My team and I advise a range of clients from endowments and foundations to global conservation trusts, as well as national parks in Africa. But we have a particular interest on what we're talking about today, which is focusing on helping private individuals, family offices, and families such as yourselves achieve philanthropic goals in the most impactful or effective way possible. So like many of you today, two of the three key aspects of my life's mission are simply to make the world a better place for animals. This includes gorillas, and protecting our planet's natural environments and vital ecosystems. That's why I support several very carefully vetted and researched charitable entities that align with those values, including this charitable entity today that we're talking about, Gorilla Doctors. So Gorilla Doctors is an organization that, in my opinion, combines every key component that I look for when analyzing a wildlife charity, from its commitment to long-term conservation, efforts to transparent and accountable approach to funding and operations. It's really first class when it comes to all of the different categories that I look for when analyzing a charity. Once again, thank you all for being here today. I want to take a quick look at the gorillas themselves, these amazing mountain gorillas who many of you have seen in person, that you saw in the video clips at the top of the program. So the population of these gorillas had declined to only 250 at the beginning of the 1980s, 250 individuals left on the planet. Today, there are almost 1,100, which may not seem like much, but that's a fourfold increase in less than 3 generations, gorilla generations. Importantly, a comprehensive scientific analysis that was completed just a few years ago attributed 50% of that 4x growth rate to the critical veterinary care provided by the Gorilla Doctors. So in my experience in wildlife conservation, it's one of the best examples that I know of what can be achieved if passionate individuals, and that's both gorilla doctors and gorilla donors, such as yourselves, unite to save, in this case, one gorilla at a time. Gorilla Doctors is an organization that really holds a unique place in the world of wildlife conservation for another reason. And that is, simply put, that we're the only group in the world that provides critical veterinary care for the mountain and eastern gorilla populations. So, as we all witness and read about an increasing number of important species in the world becoming extinct every day, it seems like, it's heartening to know that a conservation success story like this exists. However, the gorillas face a lot of ongoing challenges, and the Gorilla Doctors face challenges in our important work moving into an unknown future. So your support as a donor is vital to ensure the survival of these wild mountain gorillas and eastern lowlands. And we're grateful for your partnership and your leadership in these efforts. To accommodate your needs, Gorilla Doctors has many different ways to accept donations. And we have a slide, in fact, that will show the different types of assets and money accepted by the organization. And I think Kyle or Amy, you probably have that slide available. We should have the slide up now. Perfect, thank you very much. So obviously many different ways to donate and help the gorillas and Gorilla Doctors. But today we're going to focus on a powerful charitable giving option called the Donor Advised Fund. This option, for some of you, will be a refresher if you already use a Donor Advised Fund. For others, it'll be a good introduction. But this can help you maximize the impact of your donated dollars in very real terms. By the way, we do encourage you to check with your financial and tax advisors to ensure that DAFs are optimal for you. So when it comes to donor advised funds, from my perspective, in the world of philanthropic consulting, we simply love them. They're easy to create and use. They can increase the impact of your donated dollars, as I mentioned, in very real terms. And they allow you to track all of your charitable giving in one convenient place and then summarize that giving at year end in one convenient year end statement. So how can you create your own DAF? Well, there are multiple DAF providers. DAF providers are the ones that assist all donors in creating and managing their DAFs. You can do this to create your own customized DAF fund. Among this group, one of the most successful and one of my favorite charitable organizations in the world is Fidelity Charitable, from which we're lucky to have a very special guest with us today who will share his generously donated his time and sharing his extensive knowledge gained through experience with both donors and charities alike when using donor advised funds. From Fidelity Charitable, can we please welcome Mr. Kyle Casserino? Thank you, Kyle.
Thanks, Gary, for having me, and hopefully I can live up to that hype. So, I figured what we can do is we can start from the beginning. Just as a quick administrative item, it's important that we keep this presentation very engaging, right? So if anybody has any questions, we'll certainly save some time at the end for Q&A, but I think sometimes more importantly, if you do have a thought while we're going through the discussion, feel free to put it in the Q&A box. That's helpful that maybe we can stop and spend more time in a certain area or answer questions on the fly. And I know that we'll be monitoring that. So as we go through the presentation, just as I guess a quick reminder is I'm Kyle Casserino, and I run our Southern California, which has now turned into our more like Southwest division for Fidelity Charitable. And I've been here now 10 years, and a lot of my role is interacting with financial advisors, accountants, attorneys, family offices to really help their clients give in the most tax efficient way to their favorite nonprofits. For those on the call today that did not do the pre-webinar homework, I figure we can start, and I'll go through just a quick overview of donor advised funds. We'll cover information like the charitable landscape associated with giving. And then we'll talk through some strategies, right? So that's the idea of today is definitely not to be a sales pitch for Fidelity Charitable, but this is more to educate about the industry of donor advised funds, how they're an effective giving tool, and hopefully that comes across throughout the presentation. So really quickly is donor advised funds, what they allow individuals to do is essentially separate the timing of their tax deduction with when the funds actually have to go out to charity. Right. So donor advised funds, Fidelity Charitable and other donor advised funds are 501c3 public charities, just like how the Red Cross, Salvation Army, and Guerrilla Doctors is registered with the IRS. So donors take the tax deduction when they put the funds into the account. The assets inside grow tax-free. And then really at the donor's discretion, they're sending funds out to their favorite nonprofits really at their own pace. It's so important, I think, to take a step back and go through different profiles of donors that tend to use these vehicles. So we have a lot of donors that are what we sort of call give granters. These are individuals that use the donor advised fund strictly as an administrative tool. This could be somebody that gives even small dollar values, thinking a few $1,000s, to nonprofits every year. But at this time of the year where we are right now, during tax time, right, April 6th, that tax deadline's coming up pretty soon. We know that it becomes sort of a cumbersome activity, right, to gather all the tax receipts, cross-reference your check register. Maybe you have to check your credit card statements to see what charities you gave to, when you did it, and how much you sent to them. The donor advised fund really bridges that gap to a lot of donors, because what they'll do is they'll say, hey, I give out $10,000 a year to charity. I'll put $10,000 in my account in December, maybe in January or February, and then grant out the full amount to the charities of my choice, really when I want to, the same way I've always given to them, the same dollar amount, everything like that. The benefit for the donor, though, is the record keeping aspect. So at tax time, those donors are handing one tax receipt that they took when they funded the donor advised fund to their accountant. From a tax perspective, that's the full tax deduction amount. So that's really helpful strategy on the record keeping side for folks that are giving to multiple charities, but maybe don't want the administrative burden of, well, let's say, I have to collect all these different receipts, and chances are usually one or two slip through the cracks. Donors leave money on the table with the IRS. We have another profile of donors that what we call is somebody that thinks about it, I guess, a little bit more longer term, and they'll front load their giving, right? So this is somebody that's putting several years worth of gifting into their donor advised fund, taking a bigger tax deduction that 1 year. We'll go through those profiles and some examples a little bit later throughout the presentation, but that's very much a more common profile. Now, the grow piece. So we don't have a minimum, and a lot of donor advised funds don't have minimum funding requirements, especially the national ones like the Fidelity, Schwab's, and Vanguards of the world have all sort of eliminated their funding minimum. Some community foundations and other donor advised funds might be 25K, usually at the most. So, but when the assets are inside the account, one of the great benefits of the donor advised fund is the tax sheltered entity, right? So when the assets are in the account, they're growing tax free. There's no income tax or capital gains tax that the donor has to pay. All the growth in the donor advised fund simply means that that donor can give out more to their favorite charities over time, which is a beautiful thing. With donors that have balances, usually in a smaller range, the investment options are typically with donor advised funds, mutual funds, almost like an employer sponsored 401k. They'll have the ability to choose one or more of those. There's usually index funds, actively managed choices. Fidelity Charitable even has 5 ESG or socially responsible funds for donors that are interested in that asset class. And then the fun part is the granting. So sending funds out to your favorite charities. Now, what a big myth about donor advised funds is really is that there's a distribution requirement, right? A lot of us hear that 5% distribution that has to go out of private foundations every year. Donor advised funds don't have that same requirement. So there is no dollar value or percentage that has to go out of the account every year. Some donor advised funds have minimum requirements. For example, Fidelity Charitable requires donors to give out 1 grant to their favorite charity. The minimum is $50 per grant, so it's a really easy hurdle to get over. And keep in mind, the grant's not providing any additional tax benefits back to the donor. That tax deduction was taken up front. So this is a really easy way to organize your giving, have it in one platform. So you go online, you can check out your account. Who did I give to this year? How much did I send them last year? We have donors that tend to do things like tithing to their churches or religious house of worship, and we'll set up monthly grants that will go out in that cadence. It could be monthly, quarterly, twice a year, or once a year. So it almost works like bill pay, where you're not having to go into the account, but you automate the grant payments to your favorite organizations. And through donor advised funds, you can give to any type of 501c3 public charity that is in good standing with the IRS. Some community foundations, which we'll talk about in a little bit, have guidelines. Fidelity, Schwab, Vanguard are pretty much down the middle, left, right wing, any type of religious affiliation. As long as the IRS calls them a charity, generally speaking, you can give to them out of these types of accounts. It's important also, I think, for attendees here to understand what the landscape of donor advised funds look like. So just to give you a perspective, there's probably about 1.5 million donor advised funds at this point in time in America. And that's 99% of those are individuals like yourselves on the call. There's a small portion of that where companies are giving to their favorite nonprofits, which is that other very, very small sleeve of donor advised funds. And there's a lot of major donor advised fund providers out there. So I think it's helpful maybe just to understand the differences. So Fidelity, Vanguard, Schwab, BNY Mellon, Bank of America, all of us have our own internal donor advised fund. They're very much similar. You'll see maybe small differences in each, but I always like to say that, donor advised funds on the national level that are affiliated with financial firms, well, I always like to say it's like almost like IKEA, right? Where it's very low cost, a lot of different options. You can get your furniture quickly. So that's just, that's how I always like to equate it on the national level. And then you'll find community foundations, which are more like your boutique furniture stores. They'll be a little bit more expensive, but they'll provide items that you may not be able to get on the national level. Like, for example, there are a lot of religious affiliated community foundations that will provide a lot of guidance, information on charities that are in that religious affiliation. There are geographic donor advised funds. I'm based in Los Angeles, so we have not only the California Community Foundation here, but we have the LA, Orange County, San Diego, Santa Barbara has one. So there's a lot of different ones there that will help donors identify charities in the area, and really provide some pretty cool resources there. And even now, charities, big universities, big organizations like the United Way, those organizations are now having donor advised funds. They'll require a certain portion of the donor advised fund contribution to go back to them, but they're also just another option out there for folks. And even though there's 1.5 million donor advised funds, there's at this point in time probably over 1,000 individual donor advised fund providers. 1 out of every 3 donor advised funds in America is opened at Fidelity Charitable. Fidelity Charitable is the biggest 501c3 public charity in the US. We passed the United Way in terms of annual contributions about 6 years ago, and about 5 years ago, we passed the Bill and Melinda Gates Foundation as the largest grant maker. Last year alone, donors contributed about $11.7 billion to their Fidelity Charitable donor advised funds. And then we granted out about $11.2 billion. So you can see there's a lot of inflows and also a lot of exits, right? Where donors are really philanthropic with these vehicles. Even though we're giving out so much money. So think about it this way: is there's no minimum dollar value or percentage that you have to send out of the account. Fidelity Charitable donors still send out between 19.5% and 21.5% of our net assets annually, 4x of what a foundation has to send out, which is a great story. And then I think it's helpful to think this through as well, as so many people come to me and always are saying, well, I don't really give a lot to charity every year. Does the donor advised fund really make sense for me? And I always tell folks that private foundations sometimes have a negative connotation of having that high barrier to entry where you need to be committing millions of dollars to give to your favorite charities. Donor advised funds, very small barrier to entry. Like I said before, there's no minimum funding requirement at Fidelity and Schwab and Vanguard. And our average donor size is about 200,000 in terms of their current balance, but our median is about 21K, right? So 60% of our donor advised fund accounts are under $25,000. We'll go into a little bit more later in the presentation about why that is, but yeah, this fits every donor from somebody that's giving away maybe a couple $1,000s a year to 85 of our donors have $100 million or more in their account. So it's really all over the map. So we covered the agenda. So really quickly, just to give you a sense of the landscape, we don't have the numbers for 2022 yet, but in America in 2021, there's about $485 billion given to charity. And a lot of you on the call, I'm sure, think, well, that must be just huge foundations or massive companies that are giving out to nonprofits. 70% of that are done by individuals, just like the folks on the call today. It's a pretty significant number, and actually represents a little bit more than 3% of the US GDP. The United States has the most favorable tax treatment for folks to give to charity in any developed country in the world. Really, really cool that the government does promote that among Americans to give to charity, and we'll talk through some benefits about why. So really quickly, I always like to tell donors when they're giving cash to charity is that cash is an easy asset to give, right? You can use your credit card online, you can write a check. It's very simple and effective, and it gets deployed by the nonprofit very easily. But what a lot of folks don't know is that there's really a lot of tax benefits associated with giving appreciated assets. So what I'm thinking is anything from publicly traded stock, bonds, and mutual funds to more complex non-publicly traded assets, like, for example, maybe a private business investment, real estate, cryptocurrency. All those assets, the IRS really incentivizes people to give them because they give them a double tax benefit. So not only does the donor get the fair market value tax deduction on the value of the asset when it's contributed to the charity, but they also don't have to pay the capital gains tax on the growth, right? So that double tax benefit is huge. And we'll think about it this way, is that, let's say in this example, somebody bought Tesla stock for $20,000 and now it's worth $50,000. So this example walks through the donor that just gives the Tesla stock directly to a charity or to a donor advised fund versus selling it and then giving the after-tax cash. Really think about it this way: is you haven't had to pay the capital gains tax on that $30,000 of growth. So that means that you have A, more money to give to charity, B, a higher tax deduction as a result, and C, you've maximized the tax efficiencies of an asset that it costs you $20,000 to take a $50,000 tax write-off. So it's really, really significant. Now, so many people come to me and say, well, Kyle, I love that Tesla stock. It's done so well for me over the last 5 years. I don't want to get rid of it. That same donor was going to give $50,000 to charity anyway. So what I always tell folks is give the stock and then use the $50,000 that you would have otherwise gifted to put it back in your investment account, buy back the shares so that you can take a step up in cost basis. And what that means is that in 5 years, when let's say Elon Musk is getting way more attention to Twitter than he is to Tesla, and you want to sell the stock, you're paying the tax on the difference of today's value and that future value, not 5 years ago when you originally bought it for $20,000 in that future value. It's a very simple strategy, but I always encourage folks to look at their balance sheet and say, what's the highest percentage growth asset in my portfolio? Now, they have to be held for a year or more. So that in order for them to be long-term in nature, those are the assets to give. Unfortunately, the IRS doesn't have great tax benefits for giving short-term securities. So ones that have been held for a year or less. But if you have that investment or that inherited stock, I worked with a donor, it's going to have been more than 2 weeks ago, that for Christmas in the 80s got a stock certificate from her father for Disney stock. And the appreciation was massive, and she just hasn't sold it because she knows it's going to be a huge tax bill. Those are great assets to give to charity, ones that are highly appreciated and have gains in them. So, really, really an easy strategy there. So this is really where I'd like to spend most of the time today. And this is talking about gifting more complex or what we call non-publicly traded assets, right? So this is everything from private business interests, cryptocurrency, real estate, restricted stock. We don't have to spend all that much time here, but it is important to know that as you look at your balance sheet, like we talked about before, the best asset to give is the one with the highest percentage growth in the portfolio. So Fidelity Charitable, a lot of other donor advised funds do this work in-house. So we have a team of in-house attorneys that do these transactions all day, every day. And we help donors maximize not only the tax benefits associated with it, but more importantly, getting in front of huge income years, right? We have a lot of donors that are private business owners who are getting ready to sell a company, right? Those assets are typically illiquid. You can't gift them, you can't transfer them, but all of a sudden there's a market for them because there's a prospective buyer that's interested in acquiring the company or a portion of it. Those are all great scenarios because hey, you're finally getting some liquidity in your company, but this is also a great asset to give because the cost basis, the original investment in the asset is pretty much zero, right? It's typically very, very low. So the IRS will tax on the capital gains level almost basically the purchase price for a lot of these donors. So being able to gift an asset like that not only gets the donor the fair market value tax deduction in the high income year, they don't pay the capital gains on that portion, and they take it out of their taxable interest, which is huge. Really, I mean, it really is. And you start doing this side by side, right? People sell their companies. I mean, I was working with a donor last week that did this. They sold their company for $10 million. Accountant calls me and says, hey, we did the math. The donor needs to give away $1 million to offset some of this income this year, and they want to fund some charitable endeavors in the future. Great. So that's $10 million that you have to pay tax on first, and then you have to gift $1 million after the tax in order to get the $1 million write-off, and now you have $1 million less. You do the same thing pre-tax. Now you're only taxed on the $9 million while still getting the $1 million tax deduction. It puts a lot more money in the donor's pocket by gifting the exact same amount and achieving the exact same deduction and the charitable impact. In 2021, we took in about $350 million worth of Bitcoin. We've seen that tick up a little bit more this year. A lot of folks on the call, I'm sure, are either investors, whether that's recently or over a series of years. These are assets that could be given to charity because of their high growth potential. If you bought Bitcoin 5 years ago, you're still up thousands of percentage points, right? So these are assets that, hey, you look at your investment account and you say, well, hey, that Tesla stock's up 200%. Sometimes Bitcoin could be up a lot more than that. Other donor advised funds look at it differently. Fidelity Charitable, we receive, sell, pre-tax money goes into the investment options of the donor's choice. We don't hold on to it because of how volatile it is, but these are great assets to be able to gift. And then one area too we see a lot is with corporate insiders that have built up these big positions with their equity compensation, their restricted or control stock, and they're gifting those types of interests really during their lifetime. And the value for a lot of those folks is, well, all of a sudden I've worked at a company 10 or 15 years and now 25% of my net worth is tied up in my company's stock. This is a great way to dwindle down interest in certain assets like that. All the while achieving the charitable deduction and getting dollars to the favorite nonprofits. Similar to any trading there, it has to be done during an open window, but we can of course talk about that down the road. What's also, I think, super important is for folks to realize that charitable giving, whether it's with the intersection of donor advised funds or giving directly to charity, is a great way to, if you have a concentrated stock position or a lot of inheritance of a certain stock, it's a great way to knock that exposure down, all while gifting to your favorite nonprofits. Once in a while, for complex assets, I'll get inquiries about annuities. So we do take in whole life variable annuities, which come into play once in a while. The problem is the tax benefits really aren't there for a lot of donors. So if an annuity, let's say, was invested at 100,000, now it's worth 150. The donor gets the tax deduction on $150,000, but still has to pay income tax on the $50,000 of growth. Not a great asset to give. You get the big tax deduction, but you still have to pay income tax on the growth. So it usually makes sense to do with little or no gain in the asset. And then we can talk through, we talked through a little bit about this already, but really why people do this. These assets have a really high growth in them. So you get the fair market value tax deduction, don't have to pay the capital gains tax on the growth. We've already sort of covered that, but let's go into some pretty specific strategies for folks that benefit from donor advised funds. I would say that this is where we've seen a huge increase since 2016 on the number of accounts we've had. So I've been here now 10 years and I've seen us go from about 50,000 donor advised fund accounts to now we're at over 400,000. So many of those have been open since 2016. Why? The standard deduction doubled, right? So a lot of you are going through this exercise with your tax professional now where you're saying, you're looking at your all your deductions last year. And if you're married and filing jointly, you have to get over that $25,900 standard deduction threshold in order to actually itemize your deductions, right? So it's, you either do one or the other. You take the standard deduction, that's that 26,000 for the round number, or your itemized deductions equal more than 26,000, so you deduct the greater of those two. Now, this is married filing jointly. So what you see here is the three popular tax deductions left. SALT, that's state and local taxes. That's your property tax, but that's capped at $10,000 a year. Mortgage interest being the other one, charitable giving is the third. So those are really the three popular deductions left. Those are, a lot of those deductions were eliminated in 2016 with this Tax Cuts and Jobs Act. So this illustration you see right now is an example of somebody that maximizes the $10,000 a year in property tax deduction, has $6,000 of mortgage interest, and gives away $10,000 a year to charity. It's a pretty simple concept, but you can see they're barely getting over that $25,900 deduction, that standard deduction. So they're itemizing, but just barely, right? They're getting the $26,000 of deduction. So instead of giving the $10,000 a year directly to charities, what you can do is put in 3 years worth of giving into a donor advised fund. So you can take that $30,000 deduction this year, take the standard deductions in future years, all the while you can still give to your favorite nonprofits at the same pace you always have through the donor advised fund. The difference here is that you can really maximize the benefits, right? So you can maximize the full deduction that year. You can get well over, right? You can get well over that $26,000 standard deduction threshold. And in this example, you can see a little bit more than $7,000 of savings as a result. And of course, you take the standard deductions in future years, but this is a really easy way. It's called bunching, and it's the idea that, hey, you can put several years worth of giving, itemize your deductions the year that you put it in the donor advised fund, but the charities will never see an impact, right? Because the alternative, think about the alternative. If you really wanted to maximize your tax benefits of giving, you have to go to your charities and say, hey, I'll give you 3 years worth of giving today. Just don't expect a gift from me for another maybe 2 or 3 years. And it's awkward, not really a practical conversation a lot of people have. This is why donor advised funds have become so popular and why the average account size has shrunk a lot, mostly because of this aspect. Now, a lot of folks ask about profiles of donors. We've talked about that a little bit in the beginning. It's very important to realize that donor advised funds are really used across the map with different profiles, different age groups, but I'll give you some averages. So folks a lot of times open these accounts in their 50s or late 40s. Our average donor age is about 62 and a half, which goes to show you that most of our donors are opening these accounts and funding them on the doorstep of retirement. Folks will use their donor advised fund very similar to how they save money in their 401k during their working years, right? So somebody that's approaching retirement will put in several years worth of giving, sometimes even a generation's worth of giving, or maybe more even to engage children and family members in their giving, as a way to basically say, hey, when I'm retired, I'm not going to dip in my own pocket to give to my favorite charities, right? I already have this charitable wallet set aside. I've already earmarked these funds for charity. And not only that, but in the last few of your working years, you're able to take the bigger tax deductions and actually benefit because you're going to be in a higher tax bracket than when you're just withdrawing money from your IRA or your 401k when you're actually retired. That's what a lot of folks will do, is they'll start to build up their balances in the donor advised fund and really create almost like a plan for retirement, right? So it's like, hey, if I give, even if you give $5,000-$10,000 a year to charity and you put in maybe a couple $100,000 right before you retire, it's really going to pre-fund that retirement worth of giving. And keep in mind, assets inside are tax sheltered, they're out of your estate. So you're basically almost getting rid of the assets, but also in a way where you're benefiting from your favorite charity. You're benefiting your favorite charities by sending funds out at your own pace. The idea of having tax-free investment growth is huge. Hopefully that means that you're giving out more to charity over time than if you just are in this strategy giving out the $10,000 a year. And keep in mind, you're giving out $10,000 a year, but when you're in the lower tax bracket, it's not really benefiting you a lot. It might be helpful to also cover that gifts to public charities, which is what donor advised funds are included in, are 100% tax deductible, but donors can reduce their adjusted gross income, which is a combination of your earned wages plus capital gains tax, by up to 30% a year for gifts of appreciated assets, and up to 60% a year for gifts of cash, 50% if you combine the two. So we talked about it before, appreciated assets better to give because you get that double tax benefit. Most folks do not exceed that 30% threshold when they do this during their working years, right? You can gift 25 to 30% of your adjusted gross income, take that full tax deduction in the year that you do it. So the easy example, hey, I make $1 million. I can give $300,000 worth of that appreciated Tesla stock to the account. Now my new income level that I'm paying tax on is $700,000. And then in the exact same example, the IRS gives you a 5-year carry forward if you exceed those limits. So same deal there. Let's say your income's $1 million and it is that way for a series of years. What you can do is give $1 million to the donor advised fund. And then what you can do is take that $300,000 in year 1 to 3, and then the remaining $100,000 in year 4, all for that gift that you made in 2023. So there's a lot of creative strategies here. Gary mentioned at the beginning of the call, it is so important to consult with your CPA about your specific situation, whether or not you can benefit. But a couple other things too, before we turn it over for Q&A. A lot of people ask me about fees, right? How do donor advised funds operate? How do you keep employees there? And I think it's a good question to ask. So like we said before, different donor advised funds have different fee levels. Your national donor advised funds, so thinking about your Fidelity, Schwab's, and Vanguards being sort of the major players in this space, Our fees are all pretty consistent. They start at 0.6%, right? So that's 0.6% per year. And that's really the all-in fee for the donor. Now, all the investment choices will have a mutual fund expense ratio tied to them. So that's just the expense of the fund. But the only fee for the donor advised fund is that administrative charge. Now, community foundations are going to be more expensive, right? They're going to provide donors with a lot more resources on the community level or to the religious affiliation, but they'll typically start at maybe 1% or more on the donor advised fund admin fee. And then those charities we talked about before, very similar, they'll be a little bit more costly. So yeah, just something to be aware of there. And then a lot of folks ask me the other question too about what happens to the donor advised fund assets after I pass, right? The assets are not part of my estate anymore after I gift them. They're totally, not only are they removed from my estate, but they're not under your trust. They're not in an estate document or anything like that. What happens to them? So donors have the ability to specify individuals to be basically, most of the time, that's the next generation where your children can take over the account and give to their favorite charities with the funds, right? They don't get a check from the donor advised fund. They just have the ability to basically take over the account and can give to their favorite organizations. We allow donors also to appoint nonprofits in two capacities. They can either be outright gifts where you just say, hey, after I pass, I want X percentage to go to these 5 different charities. And then when you pass, we just send the funds out to the favorite charities and the account is then closed. But what's really interesting is that over the last, I would say, 5 years, there's been a huge push for estate planning attorneys to be naming donor advised fund as the beneficiary of estate assets, or donors will do that as the beneficiary of their IRA account, right? Where you say, hey, instead of having all these different charities linked, or working with an estate attorney 10, 15 years before you even, maybe decades before you pass, instead of naming charities outright, you can name a donor advised fund in that capacity just to organize your giving, right? So when down the road, 5 or 10 years later, you say, well, hey, one of our charities went out of business. We're more religious now. We want to start giving back to this charity. I'm really liking what Gorilla Doctors is doing. I want to up my percentage in them. Instead of going back to your attorney and amending the appendix constantly, that becomes an expensive venture, right? We all know about how much attorneys cost on the hourly rates. You can just create the one donor advised fund, name it as the beneficiary of the assets that you want to leave to charity. The assets come in there, and then what you can do is say, instead of giving this huge lump sums to charity right when I pass, you can basically create an endowment where you can support one or more charities for years and years after you die. A lot of people like to do this with scholarship funds, or the idea that, hey, my church or religious house of worship takes in maybe $100,000 and $150,000 a year. I don't love the idea of getting $3 million from my IRA account right when I pass, but being able to guarantee them $50,000 a year into perpetuity while the assets are continuing to grow tax-free becomes very attractive for a lot of donors. And that donor that passed away maybe 15 or 20 years ago is still giving to their favorite nonprofits, and the nonprofits are still seeing gifts coming from them, even though they're passed. So it's a pretty cool venture there. There's so many techniques with donor advised funds. I know we went through that pretty fast, but I wanted to give everybody some pretty actionable ideas and strategies that we see a lot. So I will stop sharing and pause for any questions that we have. Maybe Gary, if we have any questions in the chat or anything that maybe we can spend more time on, happy to do it.
Yeah, no, that was great, Kyle. Thank you very much. Really great information. I love the 3 different strategies approach, also the complex assets, something a lot of people are not familiar with, as well as the estate planning concepts. I mean, when we add that up, it can really make an enormous benefit in people's financial worlds that most people are frankly unaware of. I have one question here about private foundations. While we probably don't want to spend a lot of time getting into a great amount of detail on it, I think just a couple of compare and contrast things might be good. And I think we probably have a slide available for that as well. I know one of the key things is that you can only deduct your cost basis on assets going into private foundations instead of fair market value, which your Tesla example could be huge.
Well, yeah, and that's
Yeah.
specific to giving non-publicly traded assets, right? So if you give just publicly traded stock, you still get fair market value in both. But yeah, for the benefit of people on the call, I think it's helpful to look at the two. So a private foundation, I always tell people this is when you're considering doing one or the other, a private foundation is like opening a charitable business, right? You have to work with an attorney to draft it, get a tax ID for it. That on the low end is a $10,000 expense. And then you have to maintain the IRS requirements. So not only is the donor responsible for vetting the different nonprofits, the donor is responsible for sending out all the funds, doing the administration, working with a CPA to do an annual tax return. That costs or upfront barrier to entry is not applicable in the donor advised fund. That's why folks very rarely start foundations with anything less than maybe 2 or 3 million, because it's sort of a costly vehicle to maintain and keep up. Yeah. Now, donor advised funds don't have that requirement. It's not going to be any, there's no cost you can get, and no cost to open it. There's there's a barrier to entry that's very, very low, right? You can do it only a few $1,000s. As I tell people this too, is private foundations, despite the name, are anything but private, right? So if you have access to a computer, you can pull up the last 5 or 6 years worth of tax returns for any foundation that's out there. That's the Bill and Melinda Gates Foundation all the way to your neighbor around the streets foundation. You can see the asset level they have in it. You can see which charities they're giving to. You can see who they're paying for staff. So it's really, I mean, it's a very much a, even though it says it's a private foundation, it's very much public information. Charities, some charities actually use it as a way to contact or solicit donors based on causes they support. They'll just look at tax returns of foundations and identify ones that line up with what they're looking to accomplish as well. In the donor advised fund, the donor can tell the charity it's coming from them. They can also be completely anonymous, or they can just tell the charity what their account name is. So the charity doesn't have any way to really follow up with them. But on the Fidelity charitable tax return, it's just a comprehensive consolidation of all of our donors' gifts, right? So we're just showing how much we send to each charity, not broken down by the account level or anything like that. So those are quick hits. The donor advised fund doesn't have an annual distribution requirement. Foundation has to send out 5%. What you can do in the foundation that doesn't come into play in the donor advised fund is a lot of folks will pay family members, right? So they'll pay their cousin or niece or nephew to run the foundation and be the grant researcher and pay them a salary. That cannot be done out of the donor advised fund. Foundations, I also find a lot of times, are used for things like charity events, right? Where somebody wants to put together a dinner or raise money or put a golf outing together. And okay, let's say we're raising money for a certain cause and then have donors contribute to the foundation. These are all ways where the foundation comes into play, where the donor advised fund doesn't. I always tell folks, donor advised funds are mostly made for outright gifting, just supporting favorite charities in basically a unrestricted way, where of course donors can work with charities for specific initiatives, but they're not getting any goods or services for it.
Yeah, great information, Kyle. Yeah, I love the anything but private as well. That there are obviously various different organizations that put together those. Just a list of all of those where you can dig into any of them very easily. The form is called the 990 PF. That's the tax form, and it is public information once it's published. So really great info. I have a fun question. Don't have any questions in the chat here, but I have a fun question about, one of the things that I think is kind of interesting about DAFs is you can create your own name. Yes. For the DAF. It doesn't have to be the Kilbourn Giving Fund, for example. Right. It could be any creative name. You could name it after your dog, whatever you want, right? And I'm sure you've seen some fun things at Fidelity Charitable as well.
I've seen some fun things over the years. It's pretty cool. And I think it really gives donors a sense of purpose. And folks also will name it like the Kilbourn Family Foundation, right? Because there's no restrictions. You can name it a foundation if you want. It's not an actual private foundation, but a lot of donors do that. Also, folks will do things like in memory of, right? So like Deceased Parents Memorial Foundation, or they'll do it like the Clean Energy Fund if they support a lot of organizations that are environmental causes. I've seen a lot of scriptures over the years. What's interesting though, a lot of our donors like to give to organizations that are big, but what they hate getting is the weekly solicitations in the mail, right? So some donors will want their names to be on the grant. So let's say like John and Linda Smith Family Foundation, right? They'll name it something like that. So when they give to the Red Cross and the Salvation Army at the end of the year, they'll send it to them, give them their account name only so that the charity knows it's coming from them, but has no real way to follow up, right? They can't send them anything in the mail. They can't call them over the phone. Those are all, pretty common ways that people will name their accounts. What also I think is, and that's sort of on the family discussion, is that we have a lot of donors that use this platform within Fidelity Charitable, and it's pretty unique to Fidelity Charitable. I don't know any other donor advised funds that do this, but it's called Gift for Giving, which it's an electronic gift card that a donor can send to a friend or family member for them to then spend at their favorite charity, right? So it's all online. The recipient gets an email from the donor's account, and then the recipient can then send the funds to their favorite organization. One of my favorite stories here is we have a couple, well, several donors that use this, but one in particular are a set of grandparents that will give all the grandchildren $100 out of their account. Now, you don't have to be a certain age to get it. But what they'll do is that around Thanksgiving, they'll send it all to their grandkids. And then around Christmas, they all get back together and all the grandkids share who they gave the $100 to and why. It's so important to do this with next generation. We see so many times donors are taking over accounts. The next generation, their parents passed away. Now they have $2 million they have to give to charity, but have never really given to charity before. It's a great way for family members to instill values in the next generation, all while getting them engaged. And a lot of times family members want their kids to support the same charities that they do, but it's also good for them to have that dialogue and realize that, hey, there's other organizations out there that maybe they want to support or they're interested in, and you sort of bridge the gap between the two.
Yep. Great info. And I know people personally that have set up donor advised funds for kids to get them involved in finance and to understand, how it works, and to understand how important it is to make correct decisions or effective decisions with a DAF. And I've seen people do that with kids as young as 9 years old to get them started, and they'll fund a DAF and say, okay, well, let's research where this is going to go. And it really is a great educational tool for kids as well. And that's unless Amy, unless you have another question, I think we're good on questions.
I think we have one more, Gary. So I think so.
There is. Yeah, I saw that pop up. Yep. Thank you.
Yeah. So Don, I had a couple of questions here just for everybody in the all the attendees. I'll just read it out. So is it my understanding that goods and services cannot be exchanged for a foundation gift? Is that also true for DAFs? A charity dinner has FMV. So Don, if I understand what you're asking correctly, we see this a lot. It's called a bifurcated gift. So what that means is that, for example, for a charity dinner, a lot of times you'll get a mail or a notice and it'll say, okay, it's $1,000 to attend. $750 of that is tax deductible. The other $250 is non-deductible. It goes to the venue or the entertainment or the food and this and that. So if you have a donor advised fund, keep in mind the tax deductions you get when you fund the account are 100% deductible. So we have to make sure that all grants leaving the donor advised fund line up in that same tax deductibility manner. What it is that you can give from the donor advised fund, in that example, $750, the tax deductible portion, and then do the $250 out of pocket, right? So you can split it up and you can make sure that, okay, the tax deductible portion is covered, or you can work with the charity and just say, hey, what's the minimum ticket price it's going to cost for me to get in? They'll tell you probably in that example, oh, it's $250, and then you can make a gift of $750 on top of that. So I hope that's helpful. And I think, Don, I had another question. What if you don't have as much as $100,000 to give to charity at retirement? This is a good question, right? Because everybody gives in different levels, everybody's in different financial situations. I would say this is donor advised funds are a simple way to organize your giving, whether you're giving $5,000, $50,000, or $50 million, right? So it's a really easy way to organize it, and also benefits a lot of the charities, right? So a lot of people don't know charities, what they have to do when they're named the beneficiary of, let's say, an IRA account, they have to open an account with the financial institution. The assets get transferred in there. They have to sell, get the money back to them. We do all that work for nonprofits and almost act as a back office in those cases. So regardless of dollar value, there is a lot of flexibility to do what you want when you want for charitable giving out of donor advised funds or in your estate. And I'm happy to take anything offline if people have questions.
Yeah, that's great information. And I think that appears to be all questions. Thank you, Donna. Really great questions. So, we've covered a lot of ground today on how to give to Guerrilla Doctors, your favorite nonprofit, including discussing the effective donor advised fund strategies that Kyle's gone through. As we've seen, of course, DAFs can be a pretty powerful tool for amplifying your charitable impact. And that's why I mentioned in very real terms, because it actually effectively creates more charitable dollars going to work. But it's also important to choose the right assets, as Kyle mentioned, and to utilize strategies like bunching as one example to maximize the potential. But what's truly inspiring to me is the collective passion and care that everyone on this call has, for example, for helping Guerrilla Doctors and other endangered species and the surrounding communities in the gorilla habitat. But our passion and caring can only go so far if we don't take action. So I urge you to take the next step if you haven't, and make a difference through your giving. If you need assistance helping setting up a DAF, don't hesitate to reach out to Kyle or myself or your favorite DAF provider. As my hero oceanographer Sylvia Earle once said, no one can do everything, but everyone can do something. And it's important that we all do that something that's important to us. Whether your personal passion is for elephants or rhinos or pangolins or wolves or wild horses or burros or gorillas or something else, your support does matter. And on behalf of Guerrilla Doctors, I just wanted to thank everyone. Thank you, Kyle. Thank you, everyone, for joining and for caring. And you're all making a real difference in the world. Thank you very much.